Hey, folks, welcome to a special edition of the Mortgage Minute. In light of everything that's going on in the world today, the COVID 19 crisis, the Bank of Canada lowering its prime rate, and then bond yields going, should you defer mortgage? There's so much going on with mortgages specifically. I want to do a special Mortgage Minute again. And one key article here today, big banks cut prime rates to 2.45%. Of course, we all know that the Bank of Canada lowered their overnight lending rate. This immediately translates to banks having the ability to match that with a drop in prime. This brings prime down to 2.45%. Now, if you're lucky enough to have a discount off of prime minus 1%, for example, that makes your interest rate today 1.45%. It's fantastic. What's interesting, though, if you're just getting mortgages, if you're a new borrower, the kicker is banks have removed that discount almost unilaterally. Why? Because there's a lack of liquidity in the market. There's two things that are happening. Number one, there's a lack of liquidity for banks. They don't have the money market's gotten tight for them. Plus, they're pricing in a fear for future defaults, et cetera, et cetera. So we're going to see a lot of movement in this, but for now, there's a tightening in the discounts. Even if you don't have a discount off of prime, it's still 2.45% is a good interest rate. Begs the question whether you should lock in or not, which makes me want to look at this chart here. I've pulled this up for you. It's basically shows the 5-year bond market. So if you've got a fixed rate mortgage, it's going to be priced off of bond yields. I don't want to get into the minutia with you, but the bottom line is, if you look here, the bond market today, the bond yield is 0.58%. Keeping score at home, you can write that down, 0.58%. Add about 1.7% to that, and that's where your 5-year fixed rate should be. 1.7% on that means we should see interest rates at 2.2 or 2.3%, but we're not. Here's the thing, you're actually seeing the fixed rates moving upwards. So it's confusing for you as a consumer, saying, well, whoa, wait a second. I've always been told that if bond yields drop, 5-year fixed rates drop. Well, the point is, we've got, again, the cost of capital, risk pricing by the banks. The markets are tightened. I mean, hey, the capital markets lost 25 to 30%. You add all this up, and the banks are just not comfortable keeping the same margins they used to. So those yields that we'd normally get off of the way the pricing would normally work, just not happening today. Having said that, I think there's an opportunity to take a variable rate today and then watch for normalcy to return to the markets in, who knows, 6 months, a year from now. And if this bond yields stay where they are, there may be an opportunity to take advantage of a really low prime rate today. And then if the fixed rates do drop further, you can lock in down the road. No one's got a crystal ball, but what I'm suggesting, it's worth having the conversation. So if you have a mortgage that's coming up for renewal, and you're not sure what to do, give us a call. If you're out there shopping for a mortgage today, give us a call. Things are more complicated than normal, and this is when you need the advice. So make sure that your mortgage comes with advice. Ladies and gentlemen, I hope that helped. More important than anything else, though, I hope you're staying safe, and I hope you're staying healthy. That's the Mortgage Minute for this week. Have a fantastic week in spite of what is a crazy world today. Hope that helps you. Give me a call if you have any questions. Thanks. Bye for now.